We all want to enjoy those golden years stress-free. Kick back, relax, no money worries.
Yeah.
Well, lots of folks think they've found the secret formula with Dave Ramsey's 8% rule, and see if that rule is really all it's cracked up to be. What do you think?
It definitely sounds good on paper, right? Withdraw 8% every year and you're set. But like with most things in life, the reality is more complicated.
Right. So let's break it down. Where does this 8% thing even come from? Why is it so popular?
What's Dave Ramsey, right? Big name in finance. He's the one pushing this rule. He basically says you can safely take out 8% of your retirement savings every year.
Okay, so 8% every year. Got it.
But, and here's the catch, he assumes your investments are going to grow by an average of 12% every year.
Okay, so that 12% return, that's the linchpin, right?
Exactly.
But how realistic is that 12%? I mean, can we really expect that kind of growth year after year?
That's where things get a little, well, iffy. See, Ramsey claims the S&P 500 has earned an average annual return of 11.8% since 1926. Rounds it up to 12% for his rule.
So he's basing it on historical data.
Yeah, but he's using what's called an arithmetic average, which doesn't really paint the full picture of how investments grow over the long haul.
Okay, so the way he's calculating that average return,
It's misleading.
could you maybe break that down for us a little bit? Why is the arithmetic average not the best tool for this?
Sure. Imagine this, right? You have a killer year in the market, your investments jump up 20%. Next year, not so great, market dips, you lose 10%.
Okay, up 20, down 10 makes sense.
So if you just average those two returns, you get 5%.
Yeah, 5% gain, not bad at all.
But that 5% doesn't show what really happened to your money.
Oh, I see. So that simple average, it doesn't tell the whole story.
Nope. Because after that 20% gain, your money's bigger, right?
Yeah.
So when you lose 10%, you're losing 10% of a larger amount. So you end up with less than that 5% average would suggest.
Exactly. That's why we got to look at the order those gains and losses happen. For a more accurate picture, we use what's called the compound annual growth rate.
So it's like saying you ran a mile in 5 minutes because you ran one lap in 4 minutes and another in 6.
Perfect analogy.
Not quite how it works in the real world. How did that compare to Ramsey's 12%?
For the S&P 500 from 1926 to 2023, with dividends included, comes out to 10.12%. Quite a bit lower than his 11.8%.
Okay, so even using historical data, that 12% already seems a bit optimistic, right?
Yeah, and we haven't even factored in the inflation beast yet.
Oh, right. Inflation, that sneaky thing that eats away at our savings over time.
It's a silent killer. And when we account for it, that S&P 500 return from 1926 to 2023 shrinks down to 6.96%.
So we're talking a whole different ballgame now, huh?
Okay, so we've got two strikes against the 8% rule already. Inflated return assumptions, the silent but deadly inflation. Anything else we're missing here?
Oh, yeah. Big one, actually. Diversification, or rather, the lack of it.
Right, diversification. Don't put all your eggs in one basket.
Exactly. But Ramsey, well, he seems to be all about putting everything into stocks.
And that's risky, right? Especially for retirement.
Very risky, especially if you're relying on those investments for income.
So even if we get lucky and hit those high returns, an all-stock portfolio could still have some wild swings, right?
Absolutely. Big drops, what we call drawdowns, can be scary, especially when you need that money to live on. It's not just about the average return. It's about how low your portfolio can go in any given year.
So those drops could really mess up your withdrawal plans.
Exactly. And that's even before we talk about the hidden danger lurking in the shadows, sequence risk.
Sequence risk. Okay, now that sounds kind of ominous.
It is. Imagine this. You retire just as the market takes a nosedive.
Ouch. Not a good start.
Even if things recover later, those early losses can decimate your savings. And it's tough to bounce back from that.
So timing really is everything, not just about the average return over the long term.
Right. Look at the S&P 500 returns from January 2000 to October 2023. If you retired right when the dot-com bubble burst, your return would have been a measly 6.70%.
Wow, not even close to that 12% Ramsey talks about.
Nope.
So sequence risk, that's something to really keep in mind. 3 strikes against the 8% rule, unrealistic return expectations, inflation eating away at our buying power, the need to diversify to avoid those scary market drops, and this hidden danger of sequence risk.
Yep, definitely not as simple as it sounds.
It sounds like relying on this rule, especially without a deeper understanding of these factors, could be a recipe for disaster in retirement.
Couldn't have said it better myself. Retirement planning, it's not a one-size-fits-all kind of thing. It's about your specific situation, your goals, and how much risk you're comfortable with.
So it sounds like this 8% rule might be a good starting point for a conversation, but it's definitely not the end-all, be-all of retirement planning.
Not even close. It's all about, really understanding what you're getting into with retirement planning. No more shortcuts, got to think things through.
Yeah, we've seen how those simple rules, like this 8% thing, can give us a false sense of security, especially when they're built on, overly optimistic ideas about how the market works.
Exactly. And even if we did get those high returns, inflation is always there, lurking in the background, eating away at our savings little by little.
We can't just ignore it, right?
Right. So if we can't just blindly trust a rule like that, how do we even start to figure out a safe withdrawal rate? I mean, where do we begin? It all feels kind of overwhelming.
Well, I think it starts with understanding yourself, your financial situation right now, what you want your retirement to look like, and how much risk you're comfortable with.
Okay, so kind of like taking a personal inventory before we even start planning. What are your expenses going to look like in retirement? How much income will you have? How long will that income last? These are all important questions to consider.
It's like taking stock of your pantry before you go grocery shopping. Got to know what you've got before you can figure out what you need.
Perfect analogy. Once you have a handle on your current situation and where you want to be, then you can start thinking about how to bridge that gap. That's where things like, diversification, figuring out your asset allocation, choosing the right withdrawal strategies all come into play.
Okay, so we talked about diversification earlier, how it can help manage risk. But how do we know what to diversify into? Stocks, bonds, real estate. It feels like a guessing game sometimes.
Diversification is not about throwing darts at a board, that's for sure. It's a more strategic approach. It's about spreading your money across different types of assets like stocks, bonds, real estate. The idea is to create a portfolio that matches your risk tolerance and how long you plan to invest.
So someone closer to retirement, they might want to lean more towards bonds, right? Because they're generally considered safer than stocks.
Exactly. Protect that nest egg. But if you're younger, have more time to ride out those market ups and downs, then you might feel more comfortable putting a larger chunk of your money into stocks.
Okay, so it's not a one-size-fits-all approach. It's really about finding that balance between risk and reward.
Right, exactly. And remember, this isn't something you set and forget. Life changes, markets shift, your needs and goals evolve, so you got to review and adjust your plan along the way.
So it's a dynamic process, not just a static plan, right?
Exactly. It's about staying flexible and adaptable.
Okay, so we've covered diversification and asset allocation. What about withdrawal strategies? We talked about how sequence risk can really hurt you in retirement. How can we manage withdrawals in a way that protects our savings from those big losses early on?
One approach is to use a flexible withdrawal strategy. This means you can adjust how much you take out based on how the market is doing.
So if the market's booming, you might be able to withdraw a little more, and if things are shaky, you tighten the belt and withdraw less.
Exactly. That flexibility can help you weather those market storms and protect your savings during those inevitable downturns.
So are there, like, different types of flexible withdrawal strategies?
Oh, there are a ton of them out there, each with their own pros and cons. The trick is finding one that aligns with your situation and how much risk you're okay with. Remember, this is your money, your retirement, your future. You're the one calling the shots.
This is starting to feel less overwhelming. It's not about blindly following a rule. It's about taking charge, understanding the risks, and making choices that line up with what we want to achieve.
That's what responsible retirement planning is all about. Moving beyond those simple rules and taking a more personalized, dynamic approach that puts you in the driver's seat.
I like that, being in the driver's seat. So we've covered a lot of ground here, but there's one question that's still nagging at me. If there's no magic number, no set-in-stone rule, how do we actually figure out what a safe withdrawal rate might be for our specific situation? Is there some kind of framework, some guidelines we can use?
That's the million-dollar question. And while there's no one-size-fits-all answer, there are some frameworks and tools we can use to figure out a withdrawal rate that makes sense for you.
Okay, so walk me through it. What would that process look like?
Well, first off, we got to acknowledge that we can't predict the future, right? But we can learn a lot from looking at how it performed in the past.
So we're not completely ignoring those historical returns.
Not at all. They can be super valuable. We can use them to get a sense of how different types of investments have done over time, taking into account things like inflation and how much the market has fluctuated.
Okay, so we're using historical data as a benchmark.
Yeah, it gives us a starting point. And then we can use that data to play out different retirement scenarios, run some simulations. Let's say you're planning to retire in 10 years and you've got a certain amount saved. We can run some simulations and see how your portfolio might perform under different market conditions.
So it's like those choose your own adventure books, but for retirement planning.
Exactly. It's a great way to stress test your plan. We can try out different withdrawal rates and see how they affect how long your savings last. This can help us figure out a range of withdrawal rates that might be sustainable for you.
Makes sense. So we're taking historical data, running some simulations, and factoring in our own personal situation to come up with a withdrawal rate that's tailored just for us.
Exactly. It's like piecing together a puzzle, using all these different bits of information to create the whole picture.
I like that. So it's not about finding that one magic number. It's about putting in the work, understanding all the pieces of the puzzle, and building a retirement plan that truly reflects our own unique circumstances and goals.
And remember, it's not a one-time thing. Your life changes. The market's always moving. Your needs evolve. Got to check in with your plan every so often, make adjustments if you need to, and stay adaptable.
Okay, I'm starting to feel a lot more confident about this whole retirement planning thing. We're not just blindly following rules anymore. We're taking control, being informed, and making decisions that align with our values.
And that's what it's all about, empowering yourself to create a retirement that you're excited about, one that fits your vision of the future.
Well, this has been a real eye-opener. We've busted that 8% myth wide open, explored the scary world of sequence risk, and learned how important it is to have a personalized approach to retirement planning. Before we wrap up, is there anything else we should be thinking about? Any factors beyond just the numbers? You know, the stuff that might really impact our retirement decisions, maybe something a little more intangible.
That's a great question, and it brings up something that often gets overlooked when we're talking about retirement, the non-financial side of things.
Okay, now you've got me intrigued. What do you mean by the non-financial side?
Retirement isn't just about having enough money, right? It's about living a fulfilling life, a life with meaning and purpose. It's about finding joy in this new chapter. There's a lot more to it than just crunching numbers and figuring out withdrawal rates.
So it's not just about reaching the destination, it's about enjoying the journey.
Exactly. It's about asking yourself some deeper questions. What are you going to do with your time? How will you stay active, both physically and mentally? What kind of legacy do you want to leave behind?
Wow, those are some big questions, the kind that could keep you up at night.
They are big questions, but they're the ones that really matter. The answers will shape your retirement experience and how fulfilling it will be.
You know, this is really making me rethink things. We're not just planning for a comfortable retirement. We're planning for a meaningful one, a life we truly love, one filled with purpose and joy.
Exactly. And those non-financial aspects, they can have a huge impact on our happiness in retirement. It's all about finding that sweet spot between financial security and personal fulfillment, living a life that's both comfortable and meaningful.
We've gone from debunking a popular financial rule to exploring the deeper meaning of retirement and everything in between.
It's crazy, right? We get so focused on the money part of retirement that we forget about the big picture, the life we actually want to live.
It's easy to get lost in those weeds, all those investment strategies and withdrawal rates.
Yeah, but at the end of the day, it's about creating a life we're excited about, a life that feels meaningful.
It's like, think of it like building a house. You need that strong foundation first, that solid financial plan. That's what supports everything else.
Okay, I like that. A solid financial plan, that's our foundation.
Right. But the house itself, that's where the magic happens. That's the life you create within those walls.
Yeah. And just like building a house, things change along the way, right? You might hit some unexpected snags, your tastes might change. Got to be able to roll with the punches and adjust your plans as you go.
So we're not just sitting back and watching our money grow. We're actively involved in shaping our retirement, making it what we want it to be.
Exactly. You're the architect of your own future.
This has been such an insightful deep dive. We've debunked this 8% myth, tackled that whole sequence risk thing, and really learned how important it is to have a retirement plan that's, actually tailored to us.
It's been great breaking this all down with you. I hope our listeners feel like they can take charge of their retirement planning and create a future they're truly excited about.
Me too. And remember, everyone, there's no one right way to do this. It's your journey, your retirement. The most important thing is to be informed, be proactive, and most of all, be excited about all the possibilities out there.
Couldn't agree more. Don't be afraid to ask for help along the way.
So to wrap up this deep dive, I want to leave everyone with this thought. Retirement, it's not just about the numbers. It's about living a life you love, a life that's both meaningful and brings you joy. Thank you for joining us on this adventure. And remember, risk happens fast, think different.